Hi everyone. I'm going to take you through on one of most recent past paper discussion, that is December 2021 question paper for corporate level financial reporting and governance. Let me share my screen. So this is the question. I'm going to discuss the answer for question number 6, that is on consolidation. Let me read question number 6. I hope at the end of this discussion you will be able to prepare consolidated financial statements for SEN PLC and its group. So I would be giving you a couple of minutes. Read the first couple of paragraphs of question number 6. Right. Let me read. Zen PLC acquired 80% of the equity shares of York Private Limited on 1st of June 2020 when the retained earnings of York stood at 110 million. The stated capital of York has not changed since 1st June 2020. Other than recording the cash paid, SEN has not made any adjustments to the financial statements arising from the information given below. On 31st December 2020, Zen and Regin Private Limited entered into a contractual arrangement to establish a new company called Vox Private Limited by investing equally 50-50%. The main feature of Vox is that the assets and liabilities held by it are its own assets and liabilities and not the assets and liabilities of Zen and Regen. Zen and Regen each have 50% ownership interest in Vox. The statement of financial position of Zen, York and Vox as at 31st March 2021 are given below. So you can see statements of financial position are given. Now all figures are in thousands. Right. Now let me go through additional information. You can see there are 7 adjustments, 7 additional information. So we will be, I can discuss one by one. Before discussing additional information, I would like to draw format of consolidated financial position. Okay, give me 1 minute. Right. When you are answering this question, what you need to do is first go through the question first. So you should understand the structure of the question. Percentage, what is the percentage acquired by the parent, and NCI, acquisition date. So those things need to be identified and highlighted. Okay, after that what you need to do is you need to draw the format. Let me draw the format. So I hope you have printed copy. So I have printed copy with me. So I'm not going to shift to soft copy of the paper. Since I have the hard copy, I would be taking figures from my hard copy. So here you should write the information to be mentioned on the face of financial statement. First, name of the reporting entity, then PLC and its group, reporting date 30th asset 31st March 2021, consolidated statement of financial position, consolidated statement of financial position, LKR thousands, LKR thousands. Then assets, this one continuation. Under assets, non-current assets, property, plant and equipment, property, plant and equipment. Now when you read second paragraph of this question, you realize that Sen has invested for another company, that is Vox, right? So based on given information, you can realize that Vox could be identified as a joint venture. Why? That Zen company focus on the net asset of the Vox, not the assets and liabilities of the Vox. Therefore, equity method would be applied. Equity method need to be used for accounting for the Vox Private Limited. Okay, so Sen and York need to be consolidated. Sen and York. Sen is the parent company, York is the subsidiary company. Right. Therefore, you can write on the face from parent company figures as well as subsidiary company figures, because when consolidation as per SLFRS 10, we need to use line by line addition method. Okay, so I would be writing parent company's figures as well as subsidiary company's figures. PPE 1,470,500 plus 990,700. Then intangible assets 2,300 plus 4,500. Then investment in York 250,000. Investment in Vox 75,000. Then keep 2 to 3 lines here. Then I would write current assets, inventory, trade receivables, inventory 1,40,700 plus 380,300. Trade receivables 2,200,700, 2,200,700 plus 260,800. Then cash and cash equivalent 123,900 plus 42,800. Right. Then total assets. Total assets. Then equity and liabilities. Under that heading, stated capital 700,000 plus 200,000. Then retained earnings. So you can write consolidated retained earnings. Consolidated retained earnings. So you can see the figures, but I'm not going to write here. So I would be preparing a couple of accounts. So let me go to next page and we'll prepare a couple of accounts. Cost of control account, consolidated earnings, consolidated earnings, then NCI, non-controlling interest, right? So this 1,240,800 can be written in the consolidated retained earnings because that belongs to the parent company's retained earnings, belongs to consolidated earnings. So you can write balance here 1,240,800. Okay, so you can put a tick for send retained earnings figure. The York, you can see 275,800. So that's the retained earnings at the reporting date. At the reporting date. So let me draw that account. Retained earnings of York. Balance 275,800. That is the balance. So what you can do is, at the date of acquisition, now already you read the first paragraph of this sum. Reporting date, what's the reporting date? 31st March 2021. Starting date 1st of April 2020. Acquisition date 1st of June 2020. 1st of June 2020. So from this date to reporting date, how many months? June 30th, June and 1, July, August, September, October, November, December, January, February, March. There are 10 months. There are 10 months. So post acquisition there are 10 months. Okay. So this acquisition was occurred during the reporting period. During the reporting period. So post acquisition period is 10 months. Okay. On the acquisition date, York stood at the retained earnings balance 110 million, so you need to increase another 3 zeros, because in the statement of financial position all the figures are presented in thousands. Therefore, in the paragraph you are given in millions. Therefore, you need to increase another 3 zeros. Right. So 110,000. Okay. 110,000. So now that 110,000 consists or includes in this figure 275,800. So what you need to do is you need to remove this one from this account, 110,000, and this should be transferred to cost of control account. So retained earnings of York at the date of acquisition. Now you can see here there is a balance. Balance means retained earnings post acquisition period. Retained earnings of post acquisition period. So what is the value? 275,800 minus 110,000. So 165,800. 165,800. So this value, now this is post acquisition retained earnings. Post acquisition retained earnings belongs to two parties, parent or else group and NCI. NCI 20%. So you can see Zen PLC acquired 80% of equity of York PLC, York Private Limited. So 80% and 20%. Then what you can do is you can take 80% of 165,800 into 80%, 132,000. That should be that 132,640 can be transferred to consolidated retained earnings. Consolidated retained earnings. 132,640. Then NCI, 20% of 165,800, that is 33,160. Here post retained earnings balance. Here post retained earnings balance. Now you can see this total 165,800 debited, I made a mistake here. This should be recorded consolidated earnings 132,640 post acquisition retained earnings. Okay, I'm repeating again. Retained earnings of York should be debited 165,800, and that value should be credited from 80% and 20% of the total value, that is 132,640. Consolidated earnings should be credited, and 20%, 33,160, that should be credited to NCI. Now retained earnings of York account would be balanced, no figure. Done. Okay, so both sides of this account tally. Right, now that entry done. Okay, so still we were writing the format. Okay, consolidated earnings. So since we open an account, at the end of reporting all the adjustments, we can take the balance of that particular account. So consolidated earnings, then NCI, then non-current liabilities, non-current liabilities, deferred taxation, 150,800 plus 72,300. Then retirement benefit obligation, retirement benefit obligation 53,400 plus 17,600. Then current liabilities, trade payables 2,970,600 plus 1,090,000. Accrued expenses 47,500 plus 23,400. Right, 23,400. Then total equity and liability. Total equity and liability. Okay. Now, as per the second paragraph of this sum, on 31st December 2020, 31st December 2020, Sen and Regain Private Limited entered into a contractual arrangement to establish new company called Vox by investing equally. Okay, so from this date there are 3 months. There are 3 months before the reporting date. Okay, so make sure if there is any adjustment, there are 3 months. There are 3 months. Okay. Right. Okay. Now we can go to adjustment number 1. We can go to adjustment number 1. Sen acquired 80% of York. Then Sen has the ownership of 50% of what is the company name? Vox. So this is a subsidiary company. This could be identified as joint venture. So equity method. So this is the answer for the section 1 of this section A. Explain the accounting treatment to be applied on Vox by Sen. So this is the answer. This is the answer for the part A. Part A. Explain the accounting treatment to be applied on Vox by Sen. So already I explained, since Zen focus on net asset of Vox Limited, it could be identified as joint venture, not joint operations. This should be joint venture. Right. Additional information number 1. Go to additional information number 1. Consideration agreed by Zen to acquire 80% of York is as follows. 250 million in cash paid immediately. That would be reflected in the statement of financial position of Zen. You can see investment. So what you can do is, here investment in York 250. So this could be transferred to cost of control account. Investment account credit, cost of control account debit 250. Investment. The next one, 50 million to be paid after 2 years from the date of acquisition. So date of acquisition now after 2 years, year number 1, year number 2, the cash proceeds is 50 million. So you need to take the present value of this 50 million. Go to 7th adjustment, use 10% discount rate. So 10% discount rate, take the present value of 50 million to be paid after 2 years at the rate of 10%. So you can divide 1 by 1 plus r power of n. So from this equation you can calculate the discounting factor. 1 divided by 1.1 power of 2, then you will be getting 0.826. Use the same value, multiply by 50. So you would be getting I would now this is 50 means 50 million, so better to take 50,000 because we would be preparing all figures in thousands. So 50,000, take the discount multiply by discounting factor, then you will be getting 41,322. 41,322. This is the present value of contingent consideration. So double entry, cost of control account debit, contingent consideration 41,322, cost of control account debit, provision for contingent consideration credit. So I will write that one in the statement of financial position. Provision for contingent consideration 41,322. The same time there is an adjustment. You need to accrue the finance cost. Now in this date, the present value is 41,322, right? So this value you need to apply the interest rate. When you apply interest rate 10%, you would be getting interest for the next year, but you should take only 10 months. So 41,322 into 10%, 10 over 12. So what's the interest? What's the interest? 3,443.5. 3,443.5. So this is the finance cost, double entry. This particular interest should borne by the parent company. Therefore, you can take that one from consolidated earnings. consolidated earnings 3,443.5. Contingent consideration account could be credited. Provision for contingent consideration account could be credited. $3,443.5. So I hope you understood the double entry. Provision for contingent consideration credit. Consolidated earnings debit. Consolidated earnings debit. So that's very clear. Right. Now first adjustment over. Now we can go to second adjustment. The fair value of the remaining 20% of York as at 1st of June 2020 was 55 million. Meaning the fair value of NCI is 55 million. Therefore you can record that one in relevant accounts. So cost of control account debit 55,000, NCI account credit 55,000. So this is the double entry. Here you can write NCI, here you can write cost of control. That entry is done. Then moving on to the third adjustment. The fair values of the assets and liabilities of York as at 1st of June 2020 were equal to their carrying amounts except for the following. The fair value of the land was 30 million excess in its carrying value. So that's very simple. 30 million excess. So here you can write 30 million. Cost of control account credit 30,000. Land debit 30,000. Here you can add 30,000. And there is an impact on deferred taxation. There is an impact on deferred taxation. Read the next sentence. Fair value gains are taxable at the normal tax rate at the time of realization. So there is impact on deferred taxation. So look at tax rate, that is 24%. Tax rate is 24%. So take now when tax accounting base goes up, taxable temporary difference would increase. Therefore, as a result, deferred tax liability will increase. So that's a deferred tax also should be adjusted at the acquisition date. So all these adjustments should goes to cost of control account because everything would happen in the acquisition date. Therefore, that should be adjusted through cost of control account. Please keep that in your mind. So 30,000 into 24%, 7,200. That's a liability. So cost of control account credit, this one land, deferred tax adjustment 7,200. Deferred tax, right? Deferred tax 7,200. This is the debit entry. So you should credit this to deferred tax liability 7,200. So that's the entry for that. Okay. From the first couple of paragraphs, they clearly mentioned that stated capital of York has not changed since 1st of June 2020. Therefore, you can take the stated capital of subsidiary company, that is 200,000. So this 200,000 can be transferred to cost of control account. So stated capital of York Private Limited debit, then cost of control account credit 200,000 stated capital. Okay, right. Now we can go to second bullet point of the third adjustment. The fair value of the building was 10 million lower than its carrying amount. Lower than its carrying amount. So what is the double entry? So cost of control account debit 10,000. Building account credit 10,000. So go to statement of financial position. So here you should credit 10,000. Decrease property plant equipment decrease by 10,000. Okay. So there is an impact. There is an impact on deferred tax. There is an impact on deferred tax. So 10,000 into 24%. Into 24%. So what is the value? 2,400. 2,400. So what you need to do is now accounting base decrease. Accounting base decrease. So what would happen to deferred tax? Deferred tax liability will decrease. So from here you should deduct. So I would use different color. 2,400. Deferred tax liability decrease. That means deferred tax liability debit 2,400. So your cost of control account. Cost of control account credit 2,400. Deferred tax. Deferred tax. Right? I hope that's very clear. Then you need to adjust the depreciation. Depreciation. You need to adjust depreciation. So here you are given buildings remaining useful life is 7 years. Remaining useful life is 7 years. So let me calculate that. So we deducted 10,000. We deducted 10,000. So useful life is 7 years. Take post acquisition months, that is 10 months over 12. 10 months over 12. So 10,000 divided by 7 divided by 12 multiplied by 10. So 1,190. 1,190. So that's the depreciation. So now already it has been depreciated, right? In the consolidation, what you have done, you decrease the fair value. You decrease the fair value of building. So you need to reverse the depreciation. So 1,190 property plant equipment would be added because you are reversing depreciation. 1,190. 1,190 you reverse the depreciation. Okay, so PPE debit. PPE debit. So what would be the credit entry? What would be the credit entry? These buildings belongs to the subsidiary company. Subsidiary company. Okay, so from here 80% should goes to consolidated retained earnings. 20% should goes to NCI. 952 and 238. So property plant and equipment increase or debit, consolidated earnings credit and NCI credit. Okay, so you can write here depreciation. Depreciation. So what are the figures? $952 consolidated earnings credit then NCI 238. In addition to that, there is another adjustment on depreciation, because now at the date of acquisition, deferred tax adjustment already we have completed, but after acquisition date we reverse the depreciation, right? Okay, so for that what you need to do is you should reverse the depreciation, I mean the deferred taxation. So there is impact on deferred taxation. Okay, so now I'm going to discuss that adjustment. Okay, so we reverse depreciation 1190. Property, plant and equipment increased. That means accounting base increased. Right? Accounting base increased. But this happens after the acquisition date, during that particular period. Therefore, this deferred taxation adjustment should not be recorded in the cost of control, right? So 1190, let me just calculate the impact. 1190 multiplied by 24%, that is the rate, tax rate. So what is the impact? 1190 into 24%, 285. So that is the impact. Approximately we can take 286, because 85.6, so we'll take 286. So this is the deferred tax adjustment on the depreciation. So what is the double entry? Now tax base, accounting base increase. As a result, taxable temporary difference increase. So deferred tax liability credit 286. What are the accounts to be debited? Yes, now you can think. You cannot debit cost of control account, because this is happening after the acquisition date. Therefore you are not allowed to record this one in the cost of control account. So you need to give this impact to both parties, because this deferred tax, these assets belongs to subsidiary company. So consolidated retained earnings and NCI. So 286 into 80%, 229, and 20% of that 57. So this is the entry that you should record. So let me go to deferred taxation. I would record this one in green color. Deferred tax, I would add 286. I would write somewhere here 286 plus 286, that is the credit entry. Then debit, there are two debit entries. Consolidated earnings 229, NCI 57 debit. deferred tax. Okay, so that's the entry that you should pass to these accounts. Okay, please write in your writing book. I know you are following me while you are listening. You can answer independently, and already you have answered maybe, then you can check your answer with this. Right, now we completed bullet point number 2 in adjustment number 3. Now go to bullet point number 3. York has not recognized internally generated trade name which had a fair value of 7 million. Right. Now cost of control account, credit, intangible asset 7,000. Go to your statement of financial position. So here you can see intangible asset 7,000. In line with LK's 38 intangible asset, this trade name has 10-year useful life and it does not have any tax impact. So there is no impact on deferred tax. Because of that statement, you should not adjust for the deferred tax. However, there is a amortization, so we'll adjust for the amortization. So 7,000 is the asset that we recognized. 7,000. This should be divided by 10 and take 10 months over 12. So 7,000 divided by 10 divided by 12 multiplied by 10. So 583 approximately. That is the amortization. So what you need to do is you should deduct 583 from intangible assets. 583 intangible assets credit. You should take 80% from consolidated earnings, 20% of this value from NCI. Right. We'll go and record them. 80% is 467. 467. Approximately 467. Amortization 467. Then from NCI you can take 583 into 20%, that's 117. 117 amortization. 117. Here you can write approximately 466. 466. Otherwise there is a 1 rupee out. 466. Now you can see 466 plus 117, 583, altogether 583. Okay, so again I am repeating the entry. Intangible asset credit 583, consolidated earnings debit 466, that is 80% of that value, and NCI debit 117, that is the 20% of 583. Right, done. So that's the answer for the bullet point number 3. Now moving on to bullet point number 4. Trade debtors have impaired by 700. So I remove last 3 zeros, 700. So go and deduct 700 from debtors. From here you should deduct 700. Trade debtors, you should deduct 700 at the date of acquisition. York has not recognized this impairment in its financial statement. The impairment is deductible for the tax purpose only at the time of writing of debtors balance from the accounts in future. Right. So first we'll adjust this 700. So 700 debtors credit and cost of control account debit. Here 700 debtors, right? So there is an impact on deferred taxation because clearly mentioned there is a the impairment is deductible for the tax purpose only at the date of writing of the debtors balance from the accounts in future. So there is impact on deferred tax. So 700 into 24%, 700 into 24%. So you should add 168. So asset decrease. Therefore, deferred tax liability would decrease. Okay, deferred tax liability would decrease. So 168 minus 168 minus 168. Right. Deferred tax account debit, cost of control account credit. 168. Deferred tax on debtors. 168. Right. I hope that's clear. 700 into 24%, 168. Adjustment, deferred tax liability debit, cost of control account credit, because this happened at the date of acquisition. Therefore, deferred tax adjustment should be recorded in the cost of control account as well. So cost of control account credit, deferred tax liability account debit. That's what we did. Okay, that adjustment done. Now moving on to the fourth adjustment. York has disclosed contingent liability arising from legal case which had a fair value of 20 million as at 1st of June 2020 in its financial statements. Right. What you need to do is you need to recognize contingent liability, because SLFRS 3 clearly mentioned at the date of acquisition, if there is a contingent liability, we can recognize in the consolidated financial statements, right? So 20,000 then, cost of control account debit 20,000, contingent liability credit that can be recorded under non-current liabilities, contingent liabilities 20,000. So somewhere here I would write 20,000, right? Cost of control account debit, contingent liability account credit, done. Then Question, adjustment number 5. Adjustment number 5. Right, adjustment number 5. Sen sold a machine to York. Sen is the parent, York is the subsidiary. Sen sold a machine to York on 1st of January 2021. 1st of January 2021. Okay. So there are another 3 months before 31st March 2021. If there is a kind of depreciation, so there are 3 months. Please keep that in your mind. That particular asset has been sold for 4 million. So York should recognize that one as 4 million. Carrying value of that particular asset in the books of Sen, 3 million. So 3 million carrying value worth asset has been sold for 4 million. So unrealized profit is 1 million. 1 million means 1000. Unrealized profit is 1000. So this particular profit is kept by Sen. This particular profit is kept by Sen. So this 1000 should be reversed. PPE credit 1000. Consolidated retained earnings debit 1000. So we'll record this one first. After that we'll do the depreciation. So here PPE credit 1000, consolidated retained earnings debit 1000, unrealized profit, right, of PP. That's clear. Then what you need to do is you should reverse the depreciation. Now who did the depreciation? York, because York recorded that asset in their book, right? 1000 overvaluation. So in the console we reversed, right? So when we are reversing that as unrealized profit, what you need to do is you need to reverse the depreciation as well. Okay, so we'll do that. So 1000 is the reversed or else unrealized profit of property, plant, equipment. So useful life of that particular asset, remaining useful life of the machine was 10 years. 10 years at the date of disposal. Okay, so here you need to take 3 over 12. 3 over 12. So 1000 divided by 10, again divided by 12, multiplied by 3. 25. This 25 is the over depreciation. Over depreciation, right? So what you need to do is you should add back. You should add back 25 to PPE. Here, PPE. You should add back 25 to PPE. Okay, PPE debit. Now, this has been depreciated by York subsidiary company. I'm sorry, subsidiary company. So now we are reversing it. So you need to take from both consolidated retained earnings as well as NCI, because already that has been depreciated by York Private Limited. Okay, so 25 already you credited, you debit PPE 25, then consolidated retained earning and NCI credit. Here 80% is 20, 20% is 5, right? So 25%, 25 into 20% means 5, no? Yes. So this is the correct entry. This is the correct entry. I think there is a mistake in the suggested answer published in the website. So make sure that you record that transaction in this way, because this is very clear one, clear cut adjustment. So again I'm repeating the double entry. PPE debit 25, consolidated retained earnings credit 20, NCI credit 5. So that's the entry. Okay, let me go to financial statement. Already you debited 25, so we should credit consolidated earnings credit 20, depreciation, NCI credit 5, depreciation. That's all. Adjustment number 6 and 7 already we have taken into consideration. Now what you can do is you can take the totals of these accounts. Yeah, take the total. What's the total of cost of control account? So here when once you balance cost of control account, you can take goodwill value or else negative goodwill value. Seems debit side is higher. The total, what's the total? You can calculate the total value. 384,222. Then you would be getting goodwill. What's that goodwill? 34,654. 34,654, and here you can write goodwill 34,654. Then you can balance consolidated earnings. Consolidated earnings. Total. Before that, I forgot to adjust joint venture. So there is a joint venture. No? There is a joint venture. So here I would explain how to adjust joint venture retained earnings. Now look at retained earnings of Vox. Retained earnings of Vox is 23,000. Retained earnings of Vox is 23,000. Right? So this particular company started on that particular day. This business started on that day. Right? Therefore, this entire 23,000 earned with those two companies. Okay? So half, 23,000 into 50% belongs to the parent company. So that's the adjustment that you should make in the investment in joint venture. Let me go to this account. Investment in joint venture. So take from the investment, you can see here investment in Vox 75,000. No? So that should be credited. Investment in joint venture would be debited 75,000. Here investment. Then you should take post acquisition retained earnings. So entire value belongs to this joint venture, 23,000. Take 50% of it. That's 11,500. So 11,500 double entry. Investment in joint venture debit 11,500. Consolidated retained earnings credit 11,500. Consolidated earnings credit 11,500. Joint venture, investment in joint venture, right? So that's the double entry. Now you can take the total of these two figures, that's 86,500, 86,500, balance carried forward 86,500. So this should be reflected in the statement of financial position under non-current asset. Under non-current asset, investment in joint venture. Investment in joint venture 86,500. 86,500. 86,500. Okay. Now you can take the total of consolidated earnings account. Credit balance 1,385,912. 1,385,912. So balance carried forward. 1,380,773.5. 1,380,000. You can write this value 1,380,773.5. That's the balance for the consolidated earnings. Now we can go to NCI account. So NCI total credit side 88,403. 88,403. So balance 88,229. 88,229. 88,229. Right. Now you have taken all the balances of additional accounts that you have created. This one, all three accounts we have taken. In addition to that, investment in joint venture account balance also taken into the statement of financial position. Now what you need to do is take the totals of adjustment column. Totals of all these values. Property, plant and equipment. What's the total? What's the total? Property, plant and equipment. Total of property, plant and equipment 2,481,415. Intangible assets. Intangible assets 13,270. Investment in York, you can put a dash. Investment in Vox, you can put a dash because we have taken additional accounts. Goodwill 34,645. Investment in joint venture 86,500. Then in current assets, under current assets, inventory 1,421,000. Trade receivables 2,460,800. Cash and cash equivalent 166,700. Then stated capital 700,000. Stated capital 700,000. Deferred tax. Deferred tax. Deferred tax 228,018. Retirement benefit obligation 71,000. Provision for contingent consideration 44,765.5. Then contingent liabilities 20,000. Trade payables 4,60,600. Accrued expenses 70,900. Now you can take the totals of total asset and total equity and liability. So take the total. What's the total asset value? Let me add 2,481,415 plus 13,217 plus 34,654 plus 86,500 plus here you will be getting 2,615,786. Then you can add balance 3 accounts 1,421,000 plus 2,460,800 plus 166,700. So you'll be getting 6,664,286. 286. So you can take the balance side, equity and liability side, 700,000 plus 1,380,000 773.5 plus 88,229 plus 228,018 plus 71,000 plus 44,765.5 plus 20,000 plus 4,60,600 plus 70,900. So you will be getting same answer, 6,664,286. So this is the answer. Total asset is equivalent with equity and liability. So we adjusted all the adjustments. I hope you understood all the adjustments in the question number 6 in financial reporting governance, most recent past paper, December 2021. Please go through the answer again. So I will show again all the workings. Now this is the face. These are the relevant accounts, cost of control account, consolidated retained earnings, NCI, and here I have recorded investment in joint venture. Right. So with that, I would be showing the question that I have discussed with you, question number 6. So this is the question. All these adjustments we have taken into consideration and answered. So part A already I answered, 2 marks, and part B, prepare the consolidated statement of financial position of SEN and as at 31st March 2021, it's 18 marks. So you could earn marks very easily if you know the fundamentals. So with that note, I conclude. Thank you very much.